All right, guys, let's get started. Thank you everyone for showing up. I'm really excited to have Yonah here. Really excited. If you guys haven't met him or been to any of his meetups or listened to his podcast, he provides amazing value to everyone and this amazing strategy that helped me pay zero on taxes last year. So my name is 𝙢𝙟𝙧𝙧. I am married, father of four here in Southern California, and I invest in luxury short-term rentals. That's my thing. And now my passion is helping others investing in real estate, specifically healthcare workers. I saw during the pandemic, a lot of people were burnt out in the hospital. And, you know, I just want them to create a side hustle to where they're not relying on a specific job for income. So anyway, that's me. If we haven't met, please reach out to me. And I'll leave my info. You can reach out to me on Facebook or Instagram at The Real 𝙢𝙟𝙧𝙧. So with that, we have Savannah here.
Hi, everyone. I'm Savannah. I am a registered nurse. I'm here in Los Angeles, California. I invest in primarily multifamily syndications. I own and operate those. I also have a couple single family homes. I was recently able to step down from my full-time RN position because of my real estate investment. So I'm working per diem right now at a hospital here in LA just to kind of stay relevant and in the space. But so grateful that real estate has provided me the flexibility to now work when I want to. So such a powerful tool. Alex and I were really on the same page about really wanting to spread this opportunity and knowledge and resources to as many healthcare professionals as we can, just because that's kind of where we're at and what we're passionate about. Yonah, cost segregation is such an amazing topic. I swear, Yonah, I'm sure you blow so many people's minds when you share it, because the first time I heard about cost segregation, I was like, no way you can do this. Just the loopholes in the tax system are really mind blowing. So something that if people don't know about, this is definitely a topic that you need to become more educated about if you plan on investing in real estate. He also has an amazing podcast, Weiss Advice. I've been a guest on. Alex, have you been a guest on it?
No, I'm waiting for the invite.
Oh man, Yonah.
Are you serious? Right. I didn't send you the invite yet. That's crazy. I think
got to get Alex on that podcast. But yeah, he is the man for cost segregations. He's super helpful, has a lot of knowledge and resources. When I was first learning about it, he hopped on the phone with me and shared all the different strategies about it. So he's a wealth of knowledge, and we're lucky to have him here. So with that, Yonah, go ahead and you can introduce yourself and share what you got.
Thank you very much, Savannah. Alex, it is a pleasure to be joining you guys. It's I've seen what you have done since the inception of your group and really coming together, educating people and really what you've learned, just sharing with others. And I think I'm sure there have been people in your lives who have kind of fast-tracked your growth and being able to pay that forward and giving it back to so many other people out there. I know others who have gotten a tremendous amount from it, and I just commend you for that. So thank you for inviting me to speak to you guys and speak to your group this evening about cost segregation. A little bit about myself. I'm the father of 6 children, work for the largest national cost segregation company. I'm a real estate investor myself. Thanks to Alex and all you guys, I'm looking actively into short-term rentals also because of all you guys, Avery and Luke and the whole short-term shop. I've basically been convinced of the power of short-term rentals. So actively looking, but you guys aren't making it easy because it's so competitive. So we'll find something one of these days. But invest in multifamily and self-storage. Have done some fix and flips in the past, but my main focus is 2 things mainly. Number 1 is the cost segregation. That's my full-time job. I love it. I'm passionate about helping people save taxes. And the second thing is really just adding value, helping people, connecting people. That I do. I do a Wednesday night meetup. Alex has come many times too. It's just networking, educational in real estate as well, just connecting people through the real estate industry across the country. So that's a little bit about me. I'm happy to share, whatever you guys want, really. I mean, I have a presentation if you want me to go through slides or something, or we can just have an open forum, give a little introduction. You tell me what the format you want to do, and I'm all yours.
I think the visuals are super helpful, Yonah. I think we have a mixed group of people. We have people who are seasoned investors, and we have a lot of people who are really, really new. I know even during our last meetup, and we were going heavy into Freddie Mac and Fannie Mae, I had people messaging me like, should I know these terms or
Right.
game type thing? So we really want to make it relevant for everyone. So I think the visual tools really help.
Absolutely. So let me do this. I'll share my screen, but while I am pulling up, I do have a presentation just about cost segregation in general. But what I would love to do is if everyone open the chat box, and just so, obviously there are people who have various different stages, nothing to be embarrassed about whatsoever. We're all learning here, but just cost segregation is probably this weird term. If this is the first time, so I want you to write a number in the chat box. Okay, so everyone open the chat, and I want you to write number 1, 2, 3, or 4. Number 1 is going to be, don't write it yet and tell you what for. Number 1 is going to be, if this is the first time you've ever heard about cost segregation, this meetup, like Savannah, Alex put it out there, and you're like, what is this about? Number 1, first time ever hearing about it. Number 2, you've heard the term before maybe, but don't really know what it is. So that's number 2. Number 3, you're going to write if you do know what it is and you've actually used it yourself, like Alex, you can definitely put number 3 there. And but you want to learn a little bit more, because there's always more to learn. Every time that I learn more all the time. And number 4 is really, if you're the Cost Seg King, please stand up. And I will turn the screen over to you, and that'll be you. So we want number 1, 2, 3, 4. This is the first time you ever heard of cost segregation. Put number 1. Number 2, if you heard it, really don't know much about it at all. And obviously number 3, if you've used it yourself, I do recognize some of you here. Definitely at least 5 or 6 names I recognize. So I'm sure you've used it before. Well, there you go. I got Greg and Melissa and another Melissa. And okay, Alex, obviously. Wonderful. So great. I'm glad to see we got really, I think probably the vast majority of people are of the second category. Obviously there's several more of you. Stephanie, recognize Tracy, so many familiar names and faces here as well. Great to see faces, because I've definitely seen names before and had some conversations, maybe been on some Zooms. What I would like to do as I share my screen, as I mentioned, let's do that. I forgot to do that. Yeah, let's just share that. We'll bring up the presentation here. I like to call this the magical world of cost segregation. And I call it magic. And I've given this presentation before. Some of you may have even heard this presentation before. I've given it many times, but I like to call it magic because it is really magic. Like, it doesn't make any sense. Like, sometimes it's like, how in the world is that possible? And a lot of us think that way, especially when you're exposed to some of these ideas with the tax code. But one of the things, and I do talk fast, I have a tendency to talk fast. This is streaming live, so you'll be able to watch the recording again if you don't get anything. And please ask questions. The chat is open. Just as all of you wrote the numbers in the chat, please feel free to ask anything as we're going on or at the end. I see already there's some comments in the Facebook. Alex, maybe if one of you guys are monitoring that, I saw a couple of comments there. We'll try to get to those as we come along and monitor those. So I can't see the chat while I have the presentation open, so I will just rely on one of you guys to stop me at any point, or at a certain point, just say, okay, now it's time for Q&A. Let's just jump into it. So as I mentioned, I'm part of the largest cost segregation company. We're called Madison SPECS, part of a larger commercial real estate company. Although a lot of you guys may not be necessarily investing in commercial real estate, maybe in single family, residential, especially the short-term rentals, it's still going to be applicable. So I don't want to get lost and think this is just for you. The presentation is about multifamily, but it can really be applied to anything, and it really should be applied to everything in terms of, and I want to get into something very, very specific within short-term rentals, because I do know a lot of you guys are involved in the short-term rentals. And so I do want to get into a couple of things over there, but we're just going to give up some basics here. What is cost segregation? Because some of you that said you've heard of it before don't even know what it is. With some of you that this is the first time you've ever heard of it. So we are going to go over some of the basics. What is it? How do you benefit from it? What's this thing called bonus depreciation? Is it going to last forever? Is it just a short period of time? Who should be doing this? When should you be doing it? And most importantly, what's a real estate professional? And then within that, there's a loophole specifically for short-term rentals that you can get around. But it's really important to understand all these concepts. Then multifamily, we'll do a little case study just so you understand the actual numbers themselves. But before we get to that, let's just talk about depreciation. Now, you may have thought that depreciation sounds like a negative thing, right? But it's actually a very positive thing. It's a tax deduction the IRS gives you when you buy a property. Besides for your personal residence, you get this thing called depreciation. It's based on the principle that things go down in value as time goes on. You guys understand that, right? Everyone understands that if you buy a car, right, drive it off the lot, it goes down in value, even though intrinsically it doesn't really go down in value. So to real estate, it goes down in value as time goes on, even though it's not really, it's actually probably appreciating. It's going up in value, but the IRS gives you a tax deduction based on that principle, so you're able to literally write off the property over the whole period. And we're going to explain how this happens and what the basis of this is. So the first thing you need to know is that for commercial properties, there's what's called a 39-year schedule, meaning you take that purchase price, you take the amount that you bought the property for, and now you can write off the value of that property over a 39-year period, right? A very long time. Or for residential, it's a 27.5-year period. And this is one thing that a lot of people get confused about. We're not confused, just unaware of, is that short-term rentals are considered on a 39-year schedule like commercial properties, because the IRS views it more like transient rentals, like a hotel, in which case it would be more commercial, even though it's literally the same exact house. If you're renting in long term, it would be a 27.5-year schedule. Short term, it goes to 39-year schedule. So that's one of the things you need to be aware of. What does that mean, 39-year schedule? That means, again, you take that value and now you can take a little bit of tax deduction every single year. We're talking about income taxes here, not to be confused. A lot of people think we're talking about property taxes. No, income tax deduction. So if you make money, right? You want to be making money. Have you ever heard an accountant say, well, you're making a lot of money, that means you're paying a lot of taxes. It's a good sign you're making a lot of money, right? Anyone heard that before? Yeah, okay. It's probably one of the worst lines any accountant can possibly say, especially if you're investing in real estate. But what that means is that the accountant isn't necessarily taking a proactive role in making sure that you can be saving more money, saving your income so that it goes to you and not necessarily just to Uncle Sam. And I know Alex, right? You have a great accountant who's very proactive, giving you a lot of strategies, how you came across cost segregation in the first place. And I know Ryan was on here before. I'm not sure if he's still here, but I saw his name at the very beginning, Ryan Back, who's also very active in the Facebook group and other groups, who is a tax strategist, not just someone who's going to be punching your numbers. You want to make sure you have that, because there are tax planning strategies like cost segregation that allows you to use something that you pay less taxes. That's simply how it is, okay? So how does this work? Again, basic concept depreciation, your property depreciates on a 27.5 or 39-year schedule, but there are actually components within your property that depreciate on a faster schedule. And that's the process of cost segregation, is segregating that cost, breaking out that cost, the whole overall cost, into different categories, different individual components. Okay, so let's just take a simple example here. Let's say you buy a property for $1 million. Very simple, and you can divide this, right? If you want to divide it by 2, whatever you want to do, find the exact value. Let's say you add land allocation, meaning that $1 million is not entirely going to go into the property. A certain amount goes to land, and land does not depreciate, which means you can't take that as a tax write-off. You have to subtract that. So what you're left with, which called your depreciable basis, $850,000. Before I lose anyone, what we're talking about here, and I get lost in math too sometimes, and a lot of times why people aren't really interested in taxes, like, oh no, my accountant deals with that, whatever. It's really important to just get the basics of depreciation, because the tax benefits are so much there, and your accountant isn't necessarily going to be proactive enough to go out of his way to tell you that. So it's important to just understand the basics over here. Okay, so even though it may seem a little, it's very basic math, don't worry. I'm going to simplify this as much as possible. But let's say what you're left with here is $850,000. Simple math, if you divide that by 39 years, that's called straight line depreciation. This is what every accountant knows. They know you take this thing called depreciation, you just divide it by 39, you get $21,794. Or if you, let me get my little spotlight over here so you see what I'm warning, 27.5, $30,900. Okay, so simply put, that is your tax deduction every single year. The first year is always prorated, right? So it's not going to be exactly that amount the first year, but simply put, that's how your depreciation works. What cost segregation does, and we'll see the real numbers in a second, is we're allowed to put things into a 5-year category or a 15-year category, certain properties, certain items or components that depreciate faster, that instead of a $21,000 or $30,000 deduction, you can literally double or triple, even quadruple that amount in the early years of ownership. So why is that important? Because if we're taking this directly off of our income tax, so if you made $50,000, let's say, of net income, right? After all is said and done, obviously you got all the revenue, taxes on the remaining $29,000. That's how depreciation works. But what if you can actually get more or double that, literally wipe out your tax liability to zero? What that does is you pay zero taxes on all the income from the real estate. Whether or not that can spill over to your W-2 income, whether that can spill over to other income as well, we'll get to that shortly. But simply put, we're talking right now about just real estate income. Okay, so just to recap, overview, for those of you who came late as well, how this works is we break out a property into individual components. And it used to be called, this weird name, cost segregation. It used to be called component depreciation, which makes a lot more sense. We're individually depreciating the components. And don't get lost, again, depreciation doesn't mean it's actually going down in value. It's literally just a borrowed term that we are taking a tax deduction of that value so that we can lower our tax liability. That's simply what it is. So what we're doing is breaking out all the individual components, and I'll give you an example on the next slide of what that is. We're accelerating those amounts, right? Certain things from a 39-year schedule to a 5-year schedule, certain things from a 39 to 15, et cetera. And what that does is it gives you much bigger tax deductions early on. That's simply all it is. And so here's an example, and this is very common in multifamily and other types of residential properties, where you have basically two main categories. So you have what's called 5-year personal property, and you have what's called 15-year land improvements. And what that means is you have your building, the structure, that's really the only thing that depreciates on a 39-year schedule. And that's always going to be the majority, right? When you buy a property, the structure, the roof, walls, right? Floor, foundation, doors, windows, all that stuff is structural. And that is the main value. When you build a property, the main value is going to be in all the structural components, right? But a lot of things depreciate or fall into these faster categories that the IRS has come up with. This isn't some outside, strategy, some outside way to go about doing this. This is directly from the tax code. So we need to understand the tax code and have engineers who are well versed in that and understand construction engineering in order to break out these things and say, well, you bought this house or this building, but in that are all these, right? These components here, cabinets or closets, lighting, moldings, right? Millwork, mirror, carpeting, equipment, furniture. So you can understand furniture, appliances, all these things. Those are very clear. That's personal, movable property, but stuff like the millwork or decorative lighting or dryer vent, right? Kitchen appliances, yes. Furniture, yes. But all these other things where it's like flooring and window treatments, you would never have thought that these things are not, have a faster depreciation life. You can understand, yeah, you have to replace your appliances every 5 years or 7 years or something like that, right? So it goes down in value. But all of these other things, this is the value of the cost segregation. We're identifying all these individual components and then assigning a value to them and allowing you to take the values as a tax write-off at that faster rate. Okay, so the second category was really important. And this is something people ask me all the time. What are these things that depreciate faster? And how can I know if I'm looking to buy a property, what should I be looking for to get a property that has more cost segregation, meaning more assets within that depreciate faster? And one of the things I always say is look for a property that has land improvements, because we mentioned before, land does not depreciate, but what's on top of the land does. So paving, concrete, if you have a big, right, driveway, parking spaces and things like that, or landscaping, a lot of landscaping, even pavement, pool, swimming pool, all that stuff, anything outside, right? If it's a gazebo, anything that's outside a patio, outside of the property that's not part of the land, that's all in 15-year property. It's all considered land improvements and has, the more of that you have, the more value in the overall property gets allocated to these things. And why it's so important to understand these 5 and 15-year is something we're going to call bonus depreciation shortly. We're going to get to, and you'll see why it's so important to understand how much of this you can actually get. Okay, so when just to recap again, we like to recap all the time. And if there are questions, please do not hesitate. Put them in the chat, put them in the comments on the Facebook, share this, right? Like this. If you're enjoying this, you learned something new so far, right in the chat over there or the comments on Facebook, hashtag CostSeg, right? Or say, I learned something new. Just put a like, write something there. Just make sure I know you're still awake. You're still watching this. It's late for me, but it's probably not as late for you guys. What we're doing here is we are reducing our tax liability. Getting more deductions says I made X amount of money, and instead of, unlike your W-2 job, which you may have been used to, that you get those taxes taken out of your paycheck immediately before you even see it, real estate is not like that. Real estate, you can actually make all the money. At the end of the year, you have to tally up and see, well, how much expenses do I have? How many deductions do I have? And depreciation is one of those deductions. You take that off the top, you literally have zero tax liability. And many times, even losses, which means you can actually carry forward, you can actually use those losses or those deductions in other ways. So really what we're doing is we're not creating deductions out of thin air. I want to just reiterate this. We're not creating deductions out of thin air. What we're doing is using time value of money. You have this pool, right? This imaginary pool of potential deductions that you could write off the whole value of your property over a 39-year period, but you're not really thinking about 39 years. You're thinking about right now, right? What can I do now? And you know what the rate of inflation is, right? Everyone's been reading the news and you know inflation. Well, guess what? Inflation is making your money worth less in 5 years from now, right? Or even a year from now, or even 6 months from now. So time value of money is, well, how can I use my money today, reinvest that, and make more money from my own money, right? You don't need to give it to Uncle Sam. You can use it, and that's the value, the time value of money, okay? That's the importance of cash flow when we're talking about real estate. And this is when we talk about tax benefits. You guys have heard before, right? Real estate investing, you get appreciation, you get equity, and you get tax benefits. What are these tax benefits that you keep hearing about? This is it. This is it. This is what we're talking about, depreciation. And depreciation on steroids, which is cost segregation, is just a lot more depreciation in the earlier years. That's really what we're talking about. Sorry to use that analogy in a healthcare setting. It's probably not a good one. But it's a lot of depreciation, okay, up front. So what's an example? And this is an old slide I have from a few years ago, but again, you get the point, right? In the first year, you get this huge bump, right, of extra depreciation. And then from year 6 onwards, because we're taking that 5-year property, front loading it, and you're really not getting much less after that point, meaning you're taking the whole amount of depreciation over a 39-year period. And even after year 5, when you've used the majority of those extra benefits, you're not getting much less, okay? So it's not like, oh, I'm using all my depreciation in the first year and then I have nothing. No, you're using maybe 20 or 30% in the first few years. And then after that, you still have the majority of your depreciation deduction each year, even from an individual property perspective. Any questions at this point? I see like a lot of people in the chat, maybe just guys being active and saying, great information. Thank you very much. Dropping gems. Love it. Love the comments over here. Great scenario. Okay, I see a lot of people have some very interesting specific questions. We're going to get to all of them. So keep it going. But let's move right along in this. What's this bonus depreciation? It came about, it used to be something called 50% bonus depreciation. That was only for new construction. What is bonus depreciation? Essentially, if you remember from a few slides ago where we had those examples of things that were 5-year property, personal items, or 15-year property, land improvements, the IRS says anything that has a useful life of under 20 years, which is all that stuff. Once you've done a cost segregation study and have this engineering report that breaks down the whole property into these different individual components, you now have the option to take that entire amount of accelerated depreciation in the first year. Okay, simply put, 100% bonus depreciation means you can take all of that amount in the first year. And so I mentioned it's on average about 20–30%. We'll see examples shortly. We'll see a real life example in a minute, in a few slides from now. But on average, especially for short-term rentals, I'd say it's about 20–30%. Multifamily properties as well. Office buildings, there are certain types of properties that have much more of accelerated depreciation, like mobile home parks or golf courses, where the majority of what you're buying is just those land improvements. There's not much structure involved over there, just the land improvements. Again, that's eligible for bonus depreciation. You can take that all upfront in the first year. So mobile home parks, golf courses, more like 50–80%. A lot over there if you're looking for a big type of real estate that has a huge bonus depreciation write-off, go look at mobile home parks, RV parks, golf courses. Those are the ones that are getting you the highest amount. On the lower end of the spectrum, warehouses, right? Things like that where there's not a lot inside. Maybe there's not a lot of personal property in there, just kind of structure, not going to be a lot there, maybe like 5 to 10%. So there's not going to be, but what we're talking about here is anything that is depreciating on a faster rate, whether it's new construction or whether it is, right? And I want to make this very, very clear. Your depreciation is based on your property, and it starts your schedule. You have 39 years, and I'm sorry for didn't make this clear earlier, from the day you buy it. So it doesn't have to do with the intrinsic value of the property. And I just want to say this over and over again, because the depreciation starts the day you buy it based on your purchase price. If you buy a property for $500,000 today, and then 5 years from now you sell it for $2 million, well, you start your depreciation $500,000, take for 5 years those deductions, and the new buyer starts his brand new 39-year schedule over based on the $2 million. So he's allowed to write off that amount. And it doesn't matter how much you put in as your cash equity, doesn't matter. You get the full purchase price as your depreciation amount. Okay, so even if it's seller financing, you put $0 down, but 10%, doesn't matter. You get the full amount of depreciation. So that's another important value of this depreciation thing. So it's not intrinsic to the property. It doesn't matter if the property was built in 1972 or 1905. Right? The value you're taking is that purchase price, and that's the amount you can depreciate. And again, if that's not clear enough that we're not talking about the intrinsic depreciation of the property, differently than an appraiser will look at this. The bank appraiser is going to look at the property and say, well, the roof needs to be replaced in a year, so there's not much value left in that roof. That's not what we're talking about here. We're saying you bought a property, we're going to reconstruct it, like reverse engineer the property based on your purchase price and break out all the individual components within that to be able to come back to that original purchase price. So it's really interesting, a different way. And again, that's why I call it magic, because it doesn't really make sense, like why the IRS would make this like rule up, but it's great. So we're going to use it and we're going to run with it. But bonus depreciation, just one more thing on that, I forgot this in the slide, but it is set to start phasing out in 2023, which means this year, 2021, if you buy a property in 2021 or 2022, you can utilize for your 2021, 2022 taxes 100% bonus depreciation. That means the entire amount of the 5-year, 15-year property in the first year. However, in 2023, it's going to go down to 80%, which means you can only take 80%. The other 20% can still go on those faster 5 and 15-year schedules. Something to be aware of. Now is really the time to take advantage of that, just to make that clear. Who should be doing this? Who can do this? Really anyone, as long as you are a taxable entity, a person, individual, or if you're making money. But if you are a nonprofit, okay, who's buying a property, if you have a government entity, something like that, those properties don't have the tax liability, cannot take depreciation. So too, a retirement account, if you're investing from a self-directed retirement account like a Roth IRA or solo 401k, QRP as some people call it, qualified retirement plan, you cannot benefit from depreciation. So doing a cost segregation will really not help you. Okay, it can be done, but again, you're not going to benefit from it. So since you're already in a tax shelter, there's not really going to be much benefit there. But if it's an individual estate, doesn't matter, corporation, partnership, LLC, how does it work if it's a partnership? Usually the partnership is divided, right? Just like the ownership is divided, so too is the depreciation divided. So if that's how your partnership works out, there are different ways to, come up with that operating agreement, how the partnership actually works out. But usually that's the case where you are just splitting the ownership. You're also splitting however much depreciation comes to you or your investors. So if you take on investors and they're getting a certain equity, they will also get, according to the percentage of ownership, that amount of depreciation. So that's how some of those you may see coming on, some of these passive investment opportunities, and they're advertising, bonus depreciation, and you're going to put in $100,000 and you're going to get $100,000 of depreciation. Simply how that works is just they're splitting up that amount of depreciation. That usually is happening when you're buying a property at a very high LTV, right, loan to value, where you may be putting 20% down, taking 80% loan. So the equity is 20% of the entire purchase, and you're getting 20% of that bonus depreciation, which makes sense again on average, and therefore you're getting 100% of your investment back. Hopefully that was clear. So just to give you some ideas, what are some of these properties that get the average? Again, apartments, 25, 30% on average. This is the amount that gets reallocated, again, to these faster depreciation schedules. So auto dealerships, and this can be done for any type of property, as long as it's not your personal residence. And I know we're getting into maybe some gray area there when it comes to vacation rentals. A lot of you guys have vacation rentals, and is it considered your personal residence? Is it not? Maybe I'll get to that in a second, but just any commercial property, any residential, it doesn't matter, investment, business property can be done. So if you're a doctor and you own the office that you practice in, that's considered a business property. You can take depreciation, do a cost segregation on that. We've done many medical offices that way. It's really a huge benefit when you don't even think of yourself necessarily as a real estate investor. Hopefully, as part of this group, you do now, but you may not have always. Manufacturers, again, I mentioned mobile home parks, the second one at the bottom here, off the charts, because again, majority of just land improvements. So what is this real estate professional thing? And I know I'm moving right along, want to try to cover a lot of ground. You can always listen to this back at 0.5 speed and get everything that we're saying. But what is a real estate professional? It's important to know because, as I mentioned before, depreciation is considered a deduction, right? But simply goes against your rental income. Rental income, from the IRS's perspective, is considered passive income. Now, if anyone who owns real estate knows that it's not really passive, there's not much passive about real estate, okay? Unless you're literally just writing a check and giving it to someone else as literal passive investor. But if you own any real estate, yeah, it's considered passive. From the IRS's perspective, what that means is that depreciation, which is a passive deduction, can only be used against your passive income, your rental income. Okay, I want to make sure that we understand this, because unless you are a real estate professional, and one other loophole with short-term rentals, you're going to be limited to how much of this depreciation you can even use, and therefore how much this cost segregation may in fact even benefit you. Now, if you are a real estate professional, which we're going to define in a second, which means either you or your spouse is involved in real estate trade or business, then you can use those depreciation deductions even against any other active income, not just limited to your rental real estate income. And that's really the most important part. I know Alex, right, has spoken about this in the past, and it's so important because if you get this title, and this is, what is this? This is just something you write as a one line on your occupation on your tax return, where it asks you what's your occupation. You write real estate professional. You now get this golden ticket, this tax benefit here.
Get down.
Okay, someone who's not muted should be muted. Okay, there you go. So again, just to define this is taken straight from the IRS's definition, from IRS publication. You're a real estate professional, only one of you or your spouse, only one of you needs this designation in order to get this benefit, okay? So one of you or your spouse, needs to have the following two things. Number one, you spend the majority of your time in real estate trade or business, which we're going to define in a second what those activities are, but you essentially can't have a W-2 job, okay? Even though it doesn't say this explicitly here, in every single court case that has been adjudicated in ever, right, about this topic, anyone who's also claimed to have a W-2 job and also tried to be a real estate professional simultaneously has lost. So even though technically if you spend 50% of your time, right, you work 40 hours a week, or maybe 30 hours a week, and you're spending 30, 35 hours doing real estate, even though technically it could go, but the IRS doesn't see it that way. So again, I would just want to say you can't have a full-time job besides real estate in order to get this designation. But on the flip side, you also can't just relax on a beach, and not work at all and still get this designation. You need to have at least 750 hours a year, okay, of this time materially participating. So what are these activities that you're materially participating? If you're developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, or brokering, all of these things are considered rental or real property material participation activities, okay? So if you're a real estate broker, you automatically get it. Right? If you're a real estate broker, you are automatically a real estate professional. You better make sure you are also investing in real estate so that you can take advantage of the gift of depreciation, because you can use those benefits against not just your rental income again, but against any of your active or your spouse's W-2 income. And this is the way that real estate agents or brokers make make a killing because they're also getting the tax benefit that comes along with it. But many people, even if you're not a real estate agent, you can be involved in buying property, in renting it, leasing it, managing. There are so many different ways that you can be involved in this. But again, it really needs to be main focus. And as we'll get to a little bit later, it should be tracked. Okay, you should be able to track your hours, track your time. There are many different ways, apps and things like that you can track your hours, track your time to make sure that just for audit protection. If God forbid a person will ever be audited, you want to make sure that you have that to back yourself up. There is one exception to, really two exceptions. And maybe I'll get to that after. We'll cover when is the best time to do this. But going back to the real estate professional, there are two exceptions where even without the real estate professional designation, you can also use those losses of depreciation to offset active income. One of those exceptions is if you make less than $150,000 a year of gross income, adjusted gross income, you can then use up to $25,000 against your active income. The second loophole, as far as I'm aware of, is something that's come up quite a bit in terms of short-term rentals. That if you are using a short-term rental, it becomes actually, it's less than 7 days, right? You fit these material participation. Without getting into too many details, really a discussion for a whole nother time, but you can then clarify that rental as an active rental. The depreciation is no longer subject to the passive loss activity limitations, and therefore, in simple terms, you can use your depreciation against your W-2 income, even without being a real estate professional. And the threshold for meeting those hours is much, much less than 750. There are other tests to be met. Again, a discussion for another time. I know Ryan has spoken about this extensively on many of his maybe presented to you guys, but a lot of content out there surrounding this subject. When should you be doing this? Okay, you get this question a lot, and especially now coming to the end of the year. When should I be doing this? Does it need to be done in the tax year that I buy the property? The answer is no. It does not need to be done in the actual year. You can do it really at any time, and it doesn't even need to be done in the first year of ownership. You can do this retroactively. This is called this look-back study. You can do this retroactively on a property you own for many years, or you can do it strategically when it's going to work best for you. Again, if you can't use those losses, it doesn't really make sense to get this cost segregation done, pay a few $1,000s or however much it's going to cost to get the study done itself, and then not even be able to benefit from it. But many people like to get it done in the first year of ownership. And in fact, people will reach out to me even while you're under contract and get a free feasibility analysis, understand what I can get, what are my investors potentially going to get in terms of the tax benefits, and we provide that analysis so you can know ahead of time. So people reach out at the beginning of acquisition, but when you're doing a major renovation or addition, you can do a cost segregation on that amount spent as well. Because I mentioned at the very beginning that cost segregation is based solely on your purchase price and does not go up if you get an appraisal, is not based on the value. If you bought something really discounted, unfortunately, it's based on your purchase price. If you found something really discounted, you can't take the actual market value for your depreciation deduction. You have to base it on how much money was actually spent, okay? But the only time that does change is when you make major renovations. If you're adding more money into the property and little items like that, you know exactly what it is after the property's been placed in service, you're buying some, updating some furniture, that doesn't need a whole cost segregation. You know exactly what it is. You can put it on your tax books, place in service those furnishings. But if you're doing a major like rehaul, major renovations, there's a lot of little items, a lot of things that can go in these other categories, these other components that you want to make sure that you understand where that money and where those items should be depreciated as. New construction also very easy to do, but you need to look at the actual receipts, you need to look at the invoices and prepare the study. The main thing is this study is not just, checking off items. It's a very detailed report. The IRS, anything tax related, the IRS has like crazy, ridiculous rules and hoops to jump through. It's literally like, and we'll get to shortly, the Cost Segregation Audit Techniques Guide is ridiculous. The amount of information that's required to go into an actual report of quality cost segregation study in order for it to pass an audit. Like you have to have a whole numbering system, a whole nomenclature has to be used, right? The references to the tax code on every item, et cetera. It's a really kind of tedious thing, and which is why you have companies like ours that specialize in this. But let's go into a little bit of a case study over here. And I maybe should have used the short-term rental, but we didn't. So we'll kind of just imagine this would be a short-term rental, and we're good. Or just maybe several short-term rentals. Oh, here's one, here's one, here's one. Okay, but it's a multifamily property, and it was a 32 units, a great property. The guy bought it for $1.75 million. And he bought it after many single families that he owned. And this guy actually scaled up, started doing multifamily after many years in owning a lot of single families. He decided to sell them all, so sell the whole portfolio. I know some of you guys can relate to that. We're going to sell it all. But what he wanted to do was do what's called a 1031 exchange, which is another tax loophole, sort of, where you can sell one property and buy another one through this kind of tax structure where you have a very limited time to do it, et cetera, 45 days to identify it. Long story short, you have a small window to sell one property, identify and buy a second property. And you do that through exchange, and you defer any capital gains tax. You basically don't have to pay capital gains tax on that sale if you jump through these hoops. But he wasn't able to find the properties in time and ended up just selling all the single families and had a huge capital gains tax bill that he was going to be faced with. The reason why I'm saying this is because, as we're going to see shortly, the cost segregation not only helped knock off his total income tax liability, but those passive losses from depreciation were able to offset his passive gain from the failed 1031 exchange, i.e. the capital gains tax, which is considered a passive gain. So this was a big win on multiple fronts. And so the normal cost segregation, the normal depreciation on this property would have been $54,000. Again, if you remember, you take that purchase price, take off a certain amount for the land, and then divide that by 27.5 or 39, in his case, 27.5, because it's residential, multifamily is considered residential, and would have been $54,000. Good thing for him, his net income on this property was about $120,000, $130,000. So he was still left with a large, taxable income even after that $54,000 was subtracted. So the cost segregation, how we broke it out was as follows: 15% to land, simply put, and then if you remember the main building structure, that's the main amount, 72% over $1 million. But then 15-year land improvements, $122,000, 8% of the total property, and the 5-year property, all that personal items, the furniture, the fixtures, the carpeting, the cabinets, all that stuff, 20% total. We're looking at $421,000 of extra depreciation, which he took as the 100% bonus depreciation. Now, if you remember, he said $120,000 of income, knock that off entirely, $420,000 deduction, $120,000 income. What happens? No income tax liability on that income, plus an extra $300,000 of what's called a passive loss. Now, if you can't use that in the current year, it just carries forward. You can use passive losses in future years, but he was able to use those extra passive losses, offset the capital gain tax, had zero capital gain tax from the sale, and everyone was happy. And that's the story. But this can be, a single family. It can be a short-term rental as well. And on average, 28%, that's pretty average as well for the short-term rentals, especially since you own a lot of the furnishings, a lot of those things, you're able to get those tax deductions much faster. How are we doing on time, by the way? I've not really paying attention to a clock over here.
So we have a lot of questions. People are very, very active and interested. So
okay, so I'll stop talking now. Let's take some questions. We're pretty much done here. I did the case study. I talked really fast for a long time, but you guys, for those of you who are, maybe the number 3 or the number 2 that we started at the very beginning, probably have more detailed questions. So please, just finish off with saying this is, if you want to have a look for some way, maybe you guys as healthcare professionals, if you ever a patient who has insomnia, reference them to the Cost Segregation Audit Techniques Guide. This is, a great cure for that. Yeah, basically, like I said, it's very, very tedious, detailed in order to create a whole study. Not really much about me. Disclaimer, yeah, this is not tax or legal advice. This was just educational purposes only. Do your own due diligence and speak to your own accountant. You can reach out to me, and that's all I got. So yeah, let's do some questions here.
So Alex, because you're in the live, maybe we can just popcorn and I can do one and then you can do one.
Okay, sure. Sure. Go ahead. You want to start with one?
Yeah, let me scroll all the way up here to the top. Okay. Are there any benefits to completing a cost segregation on your primary home?
So as we mentioned before, depreciation is not a deduction you can take on your personal residence. It is only for an income producing property, whether it's investment property or business property. So you cannot do a cost seg on your primary residence.
And guys, go ahead and raise your hands too if you want to go ahead and talk to Yonah. We have him on here, but this is coming from the Facebook Live. It says, if I close property in the week of, must be the last week of 2021 and no reservations for this year, can we do a cost seg and bonus depreciation for this year?
Yes, you can, as long as you place the property in service, meaning as long as it is ready to be rented out. At least one day, and maybe for short-term rentals, maybe two renters, that's a whole question in itself. But for any type of property, as long as it is rent ready during this tax year, you can take the tax benefit, the depreciation deduction for 2021.
Yeah, and if you guys are having issues renting it out, just reach out to me. I'll rent it out for you.
There you go.
Okay, Yonah, two scenarios. If one buys an older property, do renovation, replace windows, flooring, landscaping, perform a cost seg, that means they'll be able to get higher dollar versus buying a turnkey property?
Potentially. So again, as we mentioned, there is a benefit of doing a cost segregation on the acquisition itself, right? You get the benefits of your purchase price. You can take depreciation of that to the cost segregation. Then if you then do renovations, right, and put a lot of money in there, all that extra money being put in can also be depreciated. And some of it can be just written off, but most of it, if it's major capital improvements, can be depreciated, and those amounts can be in different faster depreciation categories. So you're not necessarily going to get more higher dollar value, but you will be able to depreciate those extra dollars put in.
Hey, Yonah, can you explain recapture?
Absolutely, sure. I'll try as best as I can because it's a little elusive. But recapture tax, and I do want to just clarify the difference between recapture and recapture tax. Okay, there is no difference. There's only one thing. It's called recapture tax. So people like maybe shorten it to recapture, but I'm not sure why, because it has a bad connotation. Recapture tax essentially is a capital gain tax. It's similar because it's unrealized gain. When you sell any property, right? Whether it's, rental property, obviously, you have, whether you do cost segregation or not, you take what's called not just a capital gains tax on the amount that you made on the purchase to the sale, but you also have what's called recapture tax. The amount of depreciation that you took as a deduction, you now are taxed on that amount. You're subject to that tax, okay? Now, if you take more depreciation upfront by doing a cost segregation study, you're going to have, when you sell, whenever that is, you're going to have more depreciation than if you just took straight line depreciation. However, it's not all taxed at the same rate. There are certain things that are going to be taxed at capital gains rate. There's certain things that are going to be taxed at being capped at a 25% rate. And there's certain items that are going to be taxed at the ordinary income rate. So it's very important to understand this and break it down with your accountant to make sure that you are going to be planning right. However, I'll just throw in a couple things here to kind of give you a broader picture. People think, well, if I'm anyways, and this is a common misconception I think people have about recaptures, like, why should I take all this depreciation when I'm just going to have to pay it back when I sell, right? That's the question I get all the time. Well, first of all, it's not true. You don't pay it back. When you sell, you pay a tax on the amount that you took. And you also have the time value of money that you can now reinvest that. And just because you're subject to a tax doesn't mean you have to pay it, meaning legally. I'm not saying you don't have to pay tax. I'm saying legally, if you have a passive gain, well, guess what? In this year of that sale, you can either do a 1031 exchange, which further defers that, or that capital gains and that recapture tax, or if you have other passive losses, like our friend in the multifamily case study, if you had another passive loss from a cost segregation in the year of that sale, well, guess what? You can actually use those losses to offset those passive gains, the recapture tax. Or if you just took a huge amount of depreciation and had this huge bonus depreciation and created a passive loss, any extra suspended losses from that very property get released and can offset the recapture tax on the sale. So there are multiple strategies, and there are even more besides what I mentioned. So it's not just all in a vacuum. And real estate investing should never be looked at in a vacuum, especially if your intention is to buy more than one property ever, especially during the hold period. So again, there are many ways, but just to simply explain it, recapture tax is a tax that you're subject to, similar to capital gains, on the amount of the depreciation you took.
Hey, why don't we take questions from the audience here? Like Federico, you got your hand up.
Hey, can you hear me?
Yeah, we could hear you.
Okay, so I would like to be a case study. I'm just finishing up a property right now, painting as we're speaking. If I place my property in service, I do the cost segregation. It's a townhouse. Say my HOA next year goes, no, you can no longer use it as a short-term rental. You have to go long-term. I've already claimed the cost segregation in the 2021 year. Halfway through, I turn it into a long-term. Is there any repercussions?
That's a really good question. I think the only major repercussion will be, I mean, as long as it's a long-term rental, short-term rental, it's still a rental property and you still depreciate it. And so the cost segregation is not going to change, meaning those components that depreciate on a 5-year schedule are still going to be the same components. The same structure is going to be the same structure. The only difference that I could see is that you would have to change it, the structural components, from a 39 to a 27.5-year schedule. And that's not too complicated because you don't need to amend your tax returns because it's literally going from year to year. 1 year it's this, the second year it's that. And even if it's mid-year, you can reconcile that, based on what the majority of the income is coming from. And it's not so dissimilar from a mixed use property. So a mixed use classic case where you have like an apartment building on top of a retail building. Well, you own one property, part of it depreciates on a 39-year schedule and part of it on a 27.5. So how do I actually allocate that in depreciation? The IRS has this thing called the 80-20 rule. I don't know why they came up with this, but this is the rule that if 80% of your income comes more, 80% or more comes from the commercial, from the multifamily, then it's multifamily. If any less than that, then it goes to commercial, meaning they want you to have a 39-year schedule, which is less beneficial to you because you get to take less deduction each year. So I think that would be the only repercussion. But otherwise, as long as it's a rental property, as long as you're not living in it, meaning as your own personal residence, then it would still be a rental property.
Appreciate it. Thank you.
All right, Eli, let's hear what you got.
Hey, what's going on, Alex? I'll take my question from the chat, but I was just wondering if I've got some properties in personal names. Do we need to wait to do a cost segregation on them if we're refinancing them into a series LLC? So they're in kind of are treated as a partnership right now. So it would still be 50-50 and the actual breakdown wouldn't change. But if you're moving properties around from who actually owns them,
I mean, meaning an LLC, besides how you look at it, is just a pass-through entity from a tax perspective. So it's not really changing ownership, it's just changing entities who own that. But again, it's still you that's owning the property, even within the LLC with outside the LLC, right?
So yeah, and I own half of the LLC, and then my parents own the other half.
Right.
So
okay, but again, still the same people, which means there's no real transaction from the IRS's perspective in terms of depreciation. I mean, depreciation changes ownership when there's real change of ownership, a non-arm's length transaction. Then you are. An arm's length, a regular arm's length transaction, you're going to be able to start depreciation over. In your case, it's through just changing entities. Nothing changes from depreciation standpoint.
Okay, so I don't need to wait to do the cost segregation then.
No.
There's no benefit or anything. Okay. Awesome.
None whatsoever. And again, it doesn't change. The depreciation amount doesn't change with the refinance either. It stays based on your purchase price.
Okay, that's good to know.
Lenny the boss, you're up, man.
All right. Hey, what's happening? How's everybody doing? Quick question for you. Is there a price point, where it makes sense to do?
Yeah.
wait, and also makes sense not to do, I guess?
Absolutely. Excellent question. I used to say, and you may have heard me on podcasts, right? Many, many times. I've been a guest on like 200 podcasts. And, you know, it used to be like anything over $1 million, right? That's the price point. And then it was like, okay, anything over $500,000. And I kept seeing a lot of people coming to me with properties that were even lower and still getting a very nice return, meaning the amount it costs to get the cost segregation study done is not based on the purchase price, is not based on any tax benefits, contingents, but it's kind of based on the scope of work involved. Our company, and there's many other companies out there, you know, we have a fixed rate based on the size of the property. Maybe it's, you know, starting at maybe like $2,500 up to commercial properties, you know, $5,000, $10,000, large commercial properties, right? But your average is going to be much less. That being said, if your average benefit is going to be 20 to 25%. So if you think about that on a $500,000 property, if you're going to be getting $100,000, $120,000 tax write-off, paying a couple $1,000s is probably well worth it, right? Even if you go less than that, it's a $250,000, cut that in half, and you're still getting a $50,000, $60,000 tax write-off. Even an after-tax value, that's very well worth it. And to quote one of my clients, who's like, my accountant told me I pay $4,000 and I get $20,000 write-off, it's worth it. I said, okay, man, I'm not going to tell you you're wrong, but I wouldn't recommend it for everyone. But hey, he said, this is what I want to do. That's what you can do. You can certainly benefit. And again, it's really going to come down to more than anything, how, like we said this several times throughout the presentation, how much of those tax deductions can you actually use, right? Because it's not about how much of the tax deductions you can get, right? That's pretty standard. It's how much you can use. Meaning if you don't have income or you can't use that against your ordinary income and it's just limited to your property, your rental income, then the benefit is going to be limited.
Okay. Awesome.
So simply put, just to recap that question, definitely anything over $500,000 is a no-brainer. Even less than that, it's definitely worth at least getting an estimate and seeing what the numbers look like.
Hey, Greg, you got a question?
Yeah, Yonah, good stuff. Thank you very much. And actually, I'll just comment for the group. Yonah just did one of the cost segs for me on a smaller long-term rental. It was only $287 that I paid for it, but in the end, I'm going to get a sizable tax deduction. So even at that price point, it was worth it. So that was great. Yonah, my question is just going back to the primary residence. Is there any scenario that you've ever seen where, like, there, you know, a C Corp headquarters is here in the house that can qualify for a cost seg?
It gets really sticky when we're talking about home offices and things like that, where yes, you may have a C Corp that's headquartered there, but how much of that actually occupies the entire property, right? It gets really kind of sticky when you're talking about taking depreciation on your personal residence. So I would say I'm not going to answer that question. I would leave that to your tax advisor, but probably not gonna fly.
Okay, thank you.
Hey, Colton, you got your hand up?
Yes, I had a quick question for you. So I just bought a property, and I brought all the money for the down payments, and I'll be taking all the profits. However, my dad and we applied jointly on the loan just because I didn't have 2 years tax returns history in my business. So my question for you, with that kind of being the case, who gets the tax benefits? Do we like share them? Is it just me, or how does that kind of work?
Good question. So is your dad an equal owner of the property or just a co-signer on the loan?
So we applied jointly. He's on the title.
He's on the title. And do you have any sort of, was it purchased through an LLC or anything? You have any sort of operating agreement about that, the ownership?
No.
No. So it really could go either way. I would say, typically speaking, if he has 50% title, having title on the house doesn't necessarily mean you actually own it. Meaning you may have a title, you may have a lien on it, or something like that. So I would clarify that. Maybe ask an attorney who actually owns it, because yes, typically speaking, ownership, if it is a 50-50 ownership, then you would probably get 50% of the tax benefits. However, I'm not going to say definitively. Let's say check with your attorney just to clarify that point. Because if they just are on the title and just put or a co-signer, it doesn't necessarily mean that they're going to be 50% owners. Okay. What else we got?
Hey, Yonah, I got a question. So I've been investing in short-term rentals about 1.5 years now, and I think nobody was talking about short-term rentals before that. I mean, have you seen a difference, like where it's moving from multifamily and then all of a sudden these short-term rentals? I mean, there's been this huge boom with short-term rentals. Have you noticed anything?
There is a huge boom in general in short-term rentals, meaning just in general, right? People investing in short-term rentals is definitely, and you can look on Bigger Pocket, it's gone up tremendously. And you just ask Avery to like share her numbers of like how many properties they sold this year as opposed to last year, as opposed to the year before. Definitely grown. The awareness of cost segregation has also, because it is a relatively new kind of market, is definitely awareness has grown. Definitely thank you and Avery and her group to helping to spread that awareness. But I don't think it's like changing. Real estate in general is booming, and I can just speak to our company. Of the 3,000 studies or so we've done this year, and we do pretty much every year around that amount. There has been an increase this year, but not significant. Maybe like 100 of those are short-term rentals or something like that. So it's not a significant taking over any other type of commercial. Like in the overall general, right, commercial real estate world is also booming. So, but yeah, it is a great kind of niche, a great asset class that a lot of people like yourself who can benefit from this tax benefit, even against your W-2, if you hit these material participation hours, as we mentioned. So I think that's why it's getting so much more credit.
Okay, cool. I just want to take one more question here. I think because 7 o'clock here. I know you're in the East Coast there, but someone's asking, or Matthew Peterson's asking on Facebook. He's saying, can cost segregation offset taxes from W-2 income or other Schedule C business income?
So we did touch on that. There are certain exceptions, generally speaking, unless you're a real estate professional, then the answer is no. Typically speaking, depreciation is a Schedule E deduction against Schedule E, which is rental property income. And so there are exceptions to that, as I mentioned before, with real estate professional, or if you have this loophole with the short-term rentals, you may be able to do it. Otherwise, the answer is no.
All right. Hey, Yonah, how can people get a hold of you?
Best place to find me is actually on LinkedIn. I'm very, very active on LinkedIn as a platform in general. You can also go to my website, YonahWeiss.com. You can find me here on Facebook. You can find me on Instagram, basically anywhere. But YonahWeiss.com, I can drop that in the chat. And actually, you know what? I'll chat. Another great little tool, I share this with my Wednesday night meetup. I don't know if anyone's interested. We also do a meetup Wednesday night. If you guys want to do more networking, definitely welcome to do that. But here, let me just share a link over here, and I'll share a little tip. The little tip I have for you is if you go to the bottom of the chat, and there's been a lot of great questions in the chat, and if you hit the 3 dots at the bottom of the chat, right, it says Save Chat. So you click that button, it will automatically save to a Word document when you exit the Zoom meeting. So you'll get everything that's in the chat, including my link. You can get all my stuff over there. So click that 3 dots, save the chat, and it's automatically saved once you close the message. So, but if there are a lot of questions here. I see a lot of questions on the Facebook also. I'll try to get back to those Facebook questions if I can. And if you do have any more questions, please do not hesitate to reach out to me on any of those ways that we mentioned. And I'm just very, very grateful to Alex and Savannah. You guys are awesome. I love what you're doing, and keep sending people your way because it's really, really amazing.
Yeah, and your podcast, people could listen in on your podcast. You provide a lot of value there too. So
Yes, and Alex is going to be one of our upcoming guests on the podcast. So you guys will have to look out for that.
well, all right. I think we're gonna call it a day here. Tons of questions. Sorry, guys, we can't get to all of them. We're gonna be here all night if we do.
Yeah.
But hey, everyone, thank you for attending. Savannah, what do we got next week? We got
We have the
our-
networking event. So next week we'll hop on and we'll do some breakout groups. I'm super serious, you guys. I know I say this all the time, but this is how you meet potential partners, friends in the space. It's a great, great way to scale what you're doing in real estate by connecting with other people. So you don't want to miss out on these networking events. Even if you're very, very new to real estate, just come, listen, share what you're thinking of, what you're wanting to do. It's the best way to connect with other people. So yeah, that's what we got next Monday. Thank you so much, Yonah. And you guys, seriously, hit him up. He is so willing to share his resources and his knowledge. So take him up on those offers. He's a great guy for it. Thank you, everyone, for joining.
Thank you, guys. See you guys.
Take care.
Good night.